The AI debt frenzy is sending shockwaves through financial markets, leaving traders scrambling for safety. As tech giants borrow eye-watering sums to fund their AI ambitions, investors are bracing for a potential fallout. But here's where it gets controversial. While some see this as a golden opportunity, others fear a looming bubble ready to burst. And this is the part most people miss. The surge in borrowing isn't just about tech companies, it's reshaping the entire investment landscape. Lenders and investors are increasingly turning to derivatives as a safety net, betting on the possibility of major tech players, known as hyperscalers, defaulting on their debts. This demand has sent the cost of credit protection soaring, with Oracle Corporation's credit derivatives more than doubling since September. Trading in credit default swaps (CDS) linked to these companies has skyrocketed, reaching $4.2 billion in just 6 weeks, according to Barclays PLC's Jigar Patel. That's a staggering jump from less than $200 million in the same period last year. John Servidea of JP Morgan Chase and Company notes a resurgence in client interest in single-name CDS discussions, a trend that had faded in recent years. Hyperscalers may be highly rated, but their growing debt has exposed investors to greater risk, naturally sparking more conversations about hedging, he explains. While Oracle declined to comment, the numbers speak for themselves. Trading activity, though still modest compared to the expected debt influx, signals a broader shift. Tech companies are becoming the dominant force in capital markets as they aim to revolutionize the global economy with AI. JP Morgan strategists predict investment-grade companies could issue a staggering $1.5 trillion in bonds in the coming years. Recent weeks have seen massive bond sales tied to AI, including Meta Platforms Incorporated's $30 billion offering in October, the largest corporate bond issue in the U.S. this year, and Oracle's $18 billion sale in September. Tech firms, utilities, and AI-related borrowers now dominate the investment-grade market, overtaking banks, which once held the top spot. Even junk bonds and other debt markets are bracing for a wave of borrowing as companies build data centers worldwide. But here's the catch: banks, now among the biggest buyers of single-name CDS on tech companies, are hedging their bets as their exposure to these firms surges. Equity investors are also jumping on the bandwagon, using CDS as a relatively affordable hedge against potential share price drops. For instance, protecting $10 million of Oracle's bond principal against default over 5 years costs around $103,000 annually, while a put option on Oracle shares falling 20% by next year would cost about $2,196 per 100 shares, nearly 10% of the protected share value. Money managers and lenders have good reason to tread cautiously. An MIT report this year revealed that 95% of organizations are seeing zero returns from generative AI projects. While today's biggest borrowers boast high cash flow, the tech industry's history is littered with once dominant players like Digital Equipment Corporation that faded into obscurity. Bonds that seem secure now could become risky or even default if data center profits fall short of expectations. Credit default swaps tied to Meta Platforms Incorporated began trading actively last month following its massive bond sale, and derivatives linked to CoreWeave have also gained traction. CoreWeave shares plummeted after it lowered its revenue forecast due to a delayed customer contract, highlighting the volatility in this space. Before the 2008 financial crisis, the single-name credit derivatives market was bustling, with proprietary traders, hedge funds, and bank managers using these tools to manage risk. Post-Lehman, trading volumes plummeted, and experts doubt they'll ever return to pre-crisis levels. Today, there are more hedging tools available, including corporate bond ETFs, and credit markets are more liquid thanks to electronic trading. Sal Nero of Coherence Credit Strategies views the recent spike in CDS trading as temporary, tied to the data center build-out. "I'd love to see the CDS market truly revive," he admits. But for now, activity is on the rise. Barclays' Dominique Tublin confirms, interest is definitely growing. So, is this AI-driven debt boom a sustainable revolution or a ticking time bomb? As tech companies reshape the economy, the financial world is hedging its bets. What's your take? Are we on the brink of unprecedented growth, or is this a bubble waiting to burst? Let's debate in the comments.